I'm Chris Beauchamp, Chief Market Analyst for the UK. This is the last one, as I say. This is the final webinar of the 6-part series, Trading Essentials. This one's entitled Bringing It All Together. As a reminder, this one is recorded, and all the previous ones have been recorded and either are on YouTube or you will have received them via email. So you should be able to access those recordings, YouTube probably being the easiest way. But we have been going through in the series, we've looked at a trading plan, we've looked at risk capital and position sizing, we've looked at risk management, we've also looked at famous traders and how they can help and educate us in our trading journey, and we've also looked at the fear of missing out and the dangers that go with trying to overtrade and chase markets. So today's session is really very much just going over all of that as the key points and hopefully acting as a way of rounding out the series. Don't forget, A, this is recorded, but B, you can also ask questions using the question box during the course of the webinar, which I can get to at the end. So there's time at the end of the questions. We go for about 15-20 minutes. Really. These aren't long webinars. They're trying to distill down the important principles when you're learning to trade, because we know that a lot of people are daunted by the idea of trading and they open an account and they're not sure where they go from there. So this is not about picking which markets to trade, but the principles you need to bear in mind when you are trading the markets. Before we start, we just go through the risk warnings. Spread bets and CFDs are complex instruments and come with a high risk of losing money. 69% of retail investor accounts lose money when trading with IG. We provide an execution-only service, and so there's no investment advice or recommendation. We are, of course, authorized and regulated by the Financial Conduct Authority. So in the previous 5 sessions, as I say, we looked at firstly a basic trading plan. And again, it's not about trying to overcomplicate the way you approach markets. It's very important to have an idea of what markets you want to trade, when you want to trade them, what's the time frame you're looking at, and what will be the triggers for, most importantly, opening your trades, but also perhaps looking at trying to sort of narrow down the filters for when you might close out the trade, which, as I talked about then, is really difficult. There's so much focus in trading on when you should open trades and not so much on closing. We'll come to that in a second as we go over these points. But also risk capital, looking at managing your risk. The most important thing you have really to do as a trader is to manage your risk. Everything else comes after that, really. But making sure your losses stay managed. Using stops and limits, the third part of that episode, was how you might learn to put your stops and limits in better places than a lot of people do. And we also looked at the fear of missing out and the temptation to sort of chase moves in markets. We've seen just this week, of course, we've had record highs or multi-decade highs in coffee prices, of all things. You had surges in a couple of UK companies who have become the target of bids, and the understandable element of chasing those moves, and also looking at those trends that you see in markets that go on and on and on, how you can participate in those trends. And then the last session last week was lessons from famous traders, looking at people like Jesse Livermore, Warren Buffett, of course, Paul Tudor Jones, Ed Sykota, great traders who have honed their skills over time, and how that we might take. When we talked about having a trading plan, whatever your strategy was, whatever the market you were trading was, it's important to have this plan formulated properly, to look at why you're looking to place a trade in this particular market. What's the catalyst? Does it match the plan that you've written down or you've had formulated? I would look to buy, say, dips in uptrends. I'm looking to sell rallies in downtrends. I'm looking to buy stocks that are broken out to a 20-day high, for example. This kind of idea. It almost, as I said in the webinar then, doesn't really matter what happens in the trading plan, what your approach is. The key thing is to have one. A lot of people, understandably, get fixated on the perfect entry points and the best trading plan, when the best time is to trade. The fact, of course, of trading is you won't be able to have a successful trade every single time. The market will always do things you don't expect. But you should then create a comprehensive plan that defines your goals. Look at, are you trading long term? Are you looking at short term? Are you looking at FX markets, looking at indices? Then establish the routine of opening these trades and saying, what markets fit this criteria? Where can I take advantage of this? You could look to be someone that trades in a number of different markets. You can look to narrow it down to one or two. And also crucially incorporate a degree of analysis, look at how the market's trading. Is it particularly busy? Is it particularly volatile? Is it quieter? Where's the prevailing trend? I think that's really important, I think, to get a sense of knowing where the prevailing. That's something I think actually clients are quite good at. They, traders generally, they are very good at working out something, whether it's going up or down or sideways. Actually, the data we have about the number of winning trades versus losing trades shows that people are actually quite good at that. What they're not very good at is the next part, risk management. And these two kind of overlap. We talked about risk capital in trading, the concept of risk capital, and saying if you're looking to start trading, you need to be aware that there is a learning curve, and you will end up placing trades and losing trades that reduce the amount of capital you have in your account. So it's important to start off with a fairly small amount, to learn about trading, moving on from a demo account or from paper trading, and understanding how your psychology changes when you're trading with real money. But also, just crucially, always focusing on the risk management, keeping your position sizes small relative to the overall. We say rule of thumb for trading is risk no more than 2% of your account in any one trade. So we said, as we said in that session, if you have £1,000 in your account, 2% of that is £20. So you're saying not the amount that you use up in the margin, but separately saying, oh, if I close out this trade at a loss, I want that loss to be no bigger than, in this case, £20 or 2%. Because ideally, you're looking to run your winning trades and cut your losers so that no loss is bigger to say 2%, but your winners might be 6%. So that you're making back the money you lost from the losing trades, and then you're making money. The key thing is to know that of 10 trades that you place, 2 or 3 might be the successful ones. And that's why you need to let them run, because they make back the losses you suffered and they move you into profit, rather than if you have 10 trades and 7 are losers, and the losers, if at the same amounts, you're still going to end up losing money, even though you're following your rules. And then also, or crucially, of course, if you're trading, say you win 6 times out of 10, but your losses are much bigger than your winners, you will still be losing money, even though you're winning more than you're losing. That's often the problem with traders, particularly when they're starting out. And also avoid over leveraging and over trading. Most people trade too often, I think, really. They go into expecting to trade once or twice a month, maybe, and suddenly they find themselves trading dozens of times. It does happen. Whether that's because you are not placing your stops in the right place, perhaps they're too close, so they're often getting stopped out, so you have to trade again, or you end up chasing moves in different markets because inevitably maybe the market you chose to trade isn't moving around, so you want to find something else, and you end up chasing moves that already happened. Where it also comes through over leveraging, just putting too much on any one trade, and so that you end up, say, losing 10%, 20%, and it only takes a few of those to really start to demolish an account size. So that's a key thing. We talked about managing your emotions, avoiding the fear of missing out. And this is really an important topic at the moment when you have US markets record highs. We're recording this on the last trading day of November, and you've got the Russell 2000 small cap index breaking out to record highs. It's understandable that people look back at the charts and they see what is obvious with hindsight, but clearly wasn't at the time, that I should have done this, I should have done that. And therefore, I will jump into this market without thinking about trading and how I'm going to manage my risk properly, jumping in. And avoiding the fear of missing out means essentially avoiding trying to chase these moves in markets. Something has gone down a lot, I want to be in it. And the way this works is, for example, you've got a downtrending market, it's making lower highs and lower lows. Understandably, you think, well, I should be shorting that. So you wait for it to rally quite a bit, and it rallies. And then the fear is that you will suffer a loss because it will keep rallying. So you don't sell it, even though it looks like it's topping out. And then look back at it, say 2 or 3 weeks later, and it did continue to fall. And you think, if only I traded it then. But the way emotions work, and the fear and greed, fear kicks in when you worry that you're going to end up on the wrong side. And greed kicks in when you realize you've missed the trade. You think, I must get into it now, even though the entry point I wanted isn't then. And greed also kicks in, particularly fear really kicks in more than anything else when you've got a winning trade and you think, oh, I don't want to disappear. I don't want to close this out a loss. I'm going to close this out at this profit. I've made some profit. That's a good thing. But you end up giving away the money you could have made by letting that trade run. And that goes back to our first one about cutting your losses and let your winners run, because fundamentally what catches people out are two things: letting their losses get too big, but also not letting their winners run. So what would have been a really successful trade was cut out too early. And I don't mean classic stories like I should have bought Amazon shares 20 years ago and held them and not ever looked at them again. I'm more about saying, oh, I bought the dip in, for example, Nvidia back in August. It sold off by 25%. I bought it and then I closed it out about a week later, and now it's a new record highs and I could have made so much more. That's the classic thing, because at the time you felt good because you thought you were clever, you bought it, the price rallied. That's good. I did really well. But what you could have done was you could have done much better if you'd held on, moved your stops up using things like stops and limits, particularly trailing stops, or moving your stop up to lock into profit as you go, and also remaining objective. It's really, really easy to fall into the trap of getting angry with markets and trying to get back at them. And I've missed that trade. I've been stopped out of that trade. I really want to get back into it. And then you end up trading again in too large a size, or with your stop too close, and then you suffer another loss or a much bigger loss, and it gets worse and worse and worse. It's hard to stay objective. I'm talking to you all as human beings. They're not machines. It's easy to get these emotions kicking in and to not be objective and to rationalize it to yourself. I don't think I should do it, but I'll do it anyway. It doesn't follow my plan, but I'll do it anyway. It's too large a size, but I'll do it anyway, and so on and so on. Try and stay objective. Does this meet the plan? Is this how much of my account is this using up? How much am I risking on this trade? What's my entry point here? Am I following my rules? Over and over again, and ask yourself. And this is what we find. It's trading in education. It's not a linear process. It's circular. You will go through the same thing over and over again. And this actually is something we have been learning from the great traders. A lot of them make these same mistakes over and over again. I suppose the ones that are really, really good at trading learn from their mistakes and don't repeat them again. Jesse Livermore, one of my favorite traders to talk about, he was a guy that made the same mistakes over and over again. As I said in the webinar I did last week on famous traders, Livermore made and lost fortunes. The key thing there was he was really good at making them, but he often wasn't good at keeping them, because he would overtrade, he would trade in too large a size, he would act impulsively, wouldn't follow his plan, which shows you it's hard to do. So the key things is things like keeping to your trading plan, whatever that is, whatever your investment purpose is. And when we talked about Warren Buffett, we talked about how he was criticized in the dot-com bubble for not investing in these stocks. And he missed out on those huge returns at the time. People said Warren Buffett's lost his touch. He's not a great investor anymore because he's missed out on this incredible new wave. And then when it all came crashing down, it was shown that he was still performing well because he stuck with his plan. The advantage of being a retail trader is that you don't have an investment committee or a group of investors shouting at you for not chasing these things. You can be very disciplined with yourself, but it does require a degree of self-discipline. And keep control of your risk. Everyone over and over again, the phrase, there are old traders and bold traders, but no old, bold traders. It's the thing that comes back. Everything else really is secondary to your risk and your risk management. How are you managing your risk? Are you making sure that each trade is not too large and take too much of your account? Make sure you manage your risk properly. Other stuff flows from that, but if you're not getting your risk right, then everything else won't happen. And that's the key thing, really, that people learn. I think that there's a temptation to overcomplicate things, and you have to resist it. And the most important thing is to worry about your risk management. People focus on everything else. They focus on what the Fed's doing, what the earnings are for Nvidia, what the valuations are in US markets, all this kind of thing, rather than talking about the same topic, which is risk management, which you come back to again and again and again. And just a reminder, if you've got any questions, do pop them in the question box. But the final thoughts on this in this webinar, and indeed in the webinar series, discipline. Discipline is vital, but it really is easily lost. It's easy to just get bored with the market you're trading and trade something else. It's to get bored with the plan, to get bored with an indicator. This is a really common feature that people start using an indicator. They think it's great, and then it starts to have a period where it doesn't work as well. So they get bored and have another indicator and another one, and so on. And they overcomplicate their charts, or they're trading fundamentally and they're using PE ratios, and then that's not quite working out. So they use a different ratio and a different one, and they add it all together. And they forget their discipline, or they forget their plan. They ignore their trading plan, so they stray away from the key thing about discipline. And fundamentally, I think a lot of analysts say that the key thing is to avoid the urge to make markets too exciting. Trading should be relatively routine. It should be following the same pattern again and again. Does this trade meet my requirements? If yes, then what do I do next? If no, leave it, move on. Do this over and over again. Risk management, keeping it simple. If you're always constantly checking in on your trades, you've probably got too large a size, and that's always the worry. You should put your stops in place, take the thought process, the decision out of your hands, make sure the stock's in place. And the most important thing after risk management, where it goes hand in hand, is capital preservation, making sure you're not throwing away that trading account just on silly trades on too large a size that you're suffering too many losses. Capital preservation is vitally important. It goes hand in hand with making sure your risk is managed and your stops in the right place. And we covered all of that in those previous 5 webinars, which, as I say, will be they're recorded, so they've been sent to you, but they're also on YouTube, and you can watch them again whenever you like. That was the sort of roundup webinar. Thank you very much for joining us, everyone. I don't think there are any questions at the moment, but hopefully that was a useful insight into the world of trading and learning how to start small and slowly build up your confidence when trading financial markets. I hope you found it useful. Thank you very much for joining.